Let's connect with Anirudh Datta, research head with CLSA India. Anirudh, good morning. Thank you for joining us. Let me first start with a very basic question. What is CLSA India? Is CLSA good to go? Okay. What is CLSA India's current India view? Are you neutral on India, or positive on India, or you think Indian markets, they will continue to underperform?
Right. Hi Nikunj, good morning, and thank you for having me on the show. Our India view right now is we are overall still slightly overweight on the Asia portfolio, which Chris would runs, which you will be well aware of. However, we also maintain that these are challenging times, and India has not really underperformed many of the global markets this year so far, if you look at it. But we believe these are challenging times. Markets will remain very volatile. And I would have a more cautious stance on the markets going forward, given the recent run-up that we have seen. It's fairly similar to what we saw, I think, in the beginning of the year, when the risk-on trade was on, and India was getting its share of the trade that was happening globally. With last night's results from the Greece elections, once again it seems there will be a risk-on rally in global markets, and India will get its share of the benefit. And this is also being helped by the fact that in the domestic market, we are again finding a virtue out of the fact that the FM is moving on to the Rashtrapati Bhavan, and we will have a new FM with that new hopes that things will move forward. But given the overall slowdown in the economy, I would tend to be on the cautious side.
What is your expectation from what the central bank is going to do today? Because the large consensus seems, or rather believes, that it is going to be a 25 bps CRR as well as repo rate cut that we are going to see. And more importantly, is that something that the market is already priced in?
Okay, I missed a part of your question. If you're asking about today's monetary policy that's going to come out, yeah, it seems that the bond markets are already pricing in a 25 bps repo rate cut. And some segments are also expecting a cut in CRR rate. Although our official stance has been that would rather hope to see RBI pause at this stage, because inflation is still running fairly high.
So Anirudh, at CLSA, what to your mind is the biggest concern for Indian markets? The global environment, macro, or lack of policy action?
Look, as far as the market drivers are concerned, I think we need to keep looking at the global news flow and therefore funds flow, which will keep driving up markets. But given the lack of movement in policy making, and therefore the damage to sentiments that have taken place, particularly in the corporate sector where fresh investments are concerned, and the related issue with legislations, etc., clearly if I look at medium to long term, that would be the biggest concern, because markets can keep yo-yoing in the short term, and you may see a positive move up, but that is not really a cause for big cheer when you look at the Indian economy in general. This will also impact at some point of time job creation and new employment generation, and therefore consumer sentiments as well. Consumer sentiments has weakened a bit over the last 12 months. They have not fallen off a cliff. But for example, the kind of headlines that I have seen in, for example, your sister publication's front page today about a leading IT company deferring campus hires by a few months, those kind of headlines will not help consumer sentiments at all. So we need to be mindful of that. We need to restore corporate confidence in terms of particularly where investments are concerned, which will also help in removing the infrastructural bottlenecks in the medium term. None of these are short-term solutions. Of course, in the short term, you could see some policy action which could buoy up sentiments, and I think some of it is on the discussion table. Hopes have risen in some segments after Trinamool Congress seems to be virtually out of the UPA coalition, or at least the influence seems to be a little bit diminished post the events of last week.
Anirudh, you just talked about the political scenario. There are talks that perhaps P. Chidambaram is going to get back as the finance minister. Do you think that is something that the markets would like?
Look, I don't know what the markets will like, but yeah, Mr. Chidambaram has a track record. He's known as a man who gets things going, who does get things moving. And therefore, I'm sure anyone who comes in who has reformist credentials who would enjoy the confidence also of the political bosses within the Congress party. I think that's more important. Where at the end of the day, many of the decisions that need to be taken are political decisions. It's not that one ally or was only blocking every move. There has been a lot of differences in key issues within the Congress party itself, and those need to be sorted out to get things moving forward. Whether it's diesel and LPG price increases, which are near-term measures, your land bill, for example, which has been now pending for some time. These are not just stalled by alliance partners, but also there have been a strong difference of opinion within the Congress party itself.
So given all the parameters, Anirudh, what is your sense on how equities are likely to, shape up in the next 3 to 4 months? Do you think it is going to continue to be range-bound with trading rallies intermittently, or do you think we could see a significant scale up or down?
My sense is you are in for a period where you will continue to see trading rallies, and therefore, that is what will keep driving the markets up and down. Unlikely to see a sustained market movement in any one direction in a decisive way. And as I said, global news flow will be very critical to this move up, although we may keep getting excited about local news flow. The other bit is also the data that comes out periodically, and our own sense is that this calendar year second quarter, the macroeconomic data probably will be worse than the first quarter.
So what is your 12-month price target for the Sensex, and are you somewhere working with the possibility that Indian markets could retest December lows?
Okay, what we are working with right now is we have a 12-month price target or a Sensex target, which has, if I remember correctly, about some 9-10% kind of an upside. Which is essentially based on 1-year forward price earnings multiples. Currently we are somewhere at about 12.5 or so, and where the 10-year average is something like 14.7, so we have a little bit of discount to that, and that is what gives the upside. And as I said, in our regional model portfolio for absolute return portfolio, we are running a small overweight position in India. But again, that has been significantly reduced sometime in around late last year, where we had a huge overweight on India. The reason for the reduction primarily has been weak macroeconomic fundamentals within the country, the uncertainty that's there on the policy side, and coupled with the fact that rupee could depreciate. And that's been the view that we have, and we maintain that view overall.
A week ago, Anirudh, your research team has come out with a research report that Indian PSU banks, they run the risk of policy environment and NPA cycle. To your mind, why do you think PSU banks in the near term have potential to underperform?
Okay, if you have looked at that report, again you will see the reason why we have said the PSU banks are likely to continue to underperform the private sector peers or the largest PSU bank in this country. And the reasons are their exposure to risky sectors, which are far higher as a proportionate of their, as a proportionate of their book. The chances that some of those loans go bad or restructured is fairly high. So given their exposure to the various sectors, and we have given a sector by sector I think charts and tables out there highlighting why the PSU banks are more at risk.
Anirudh, what is it that you have on your radar ahead of the policy? What sectors and stocks are you watching out for?
So, look, we really do not give out recommendations for a day or a week or even a month. So overall, our model portfolio, and within which is a balanced mix of defensives and some plays on interest rate cuts, and hopefully some amount of movement on the policy side. And our key top picks are in that sense ICICI Bank, BPCL, Power Grid, then Tata Motors. These are some of our key picks that we are running with right now, and which is what the way it has been for some time.
Yeah, so that is my follow-up question. What makes you bullish on Tata Motors? JLR seems to be slowing down. What Tata Motors reported for the quarter gone by was a big drop in margins, and if the global growth scare comes back, maybe JLR in the near term could experience some headwinds.
Sure. All that, yeah, what you've said, Nikunj, is absolutely valid. In fact, like most others, our analysts were also caught on the wrong foot about with the margin that came through in the last quarter's results. Where we are more constructive is one, the trend so far that we are seeing is that the luxury car market continues to do well globally. And if you look at last month's JLR volumes which have come out, have also come out very, very strong. Now, can global headwinds, kind of question that story? Yeah, sure, they can. As of now, we see that story still continuing to be strong. So it's essentially a call on the global volume growth in luxury car market at modest margin assumptions which were there last year, and not the exception that we saw sometime in the last quarter of last year. And the current valuations, because the stock has significantly corrected after the nasty surprise on margins in last quarter.
Anirudh, the fact that you're bullish on ICICI Bank, that really could be a value call. But ICICI Bank also has a large exposure to power sector, airline stocks. Are you not worried about the book quality?
Relatively less so, and which is why I go back to the note which our bank analysts put out last week, which you mentioned, which you referred to, and you will see that sector-wise, if you look at it, ICICI exposure are significantly less, and in some cases, like the airline sector that you mentioned, its security is significantly superior to what the other banks have, and they're still getting the money out of the escrow account, and therefore our concerns are less on that than in many of the other banks, their peer group.
Anirudh, what about consumption? Is that a theme which you think is favorable in the current market environment? And more importantly, the valuation that some of these stocks are running at?
Right. Given the valuations, if there are nasty surprises on consumption, there could be a significant correction to valuations in these stocks. I think there are two things to it. As I mentioned, over the last 12 months, I've progressively seen that the consumer sentiments are getting dampened. But thankfully, they have not yet fallen off a cliff. And one possible reason why they have not fallen off a cliff is presumably that consumers have still kept on seeing reasonable amount of wage increases, which has, in spite of the high inflation, therefore not dampened the sentiments completely. Also, there have not been very large-scale job losses, like we saw, for example, in 2008 downturn during the great financial crisis. Now, these two things have held up. The other bit which is helping the staples is penetration into rural areas and smaller towns. We have seen about, for example, Unilever talking about a company which we have always believed has had very strong distribution and penetration levels, still saying that over the last 3 years they have been able to double their reach to rural consumers. Now, therefore, there is a significant penetration story playing out there. Is this at risk? My own sense is yes, it is at risk. And like the headline that I mentioned in today's newspapers and today's Economic Times, those kind of headlines, if they garner, momentum, or we see more of those going forward, surely the consumer sentiments will get damaged more. We can see from all the empty hoardings in various cities that I travel to, and Bombay is a very good example of that. Ad spends are lower. Clearly something is, the consumer sentiments are not what they used to be 2 years back. Do they get damaged from here on further? I would think so, but how bad? I have no idea right now. And that will depend on what kind of job creation that we see, or job losses that we do not see going forward. Fact remains that wage increases this year are not going to what they were in the last 2-3 years, and that itself could dampen consumer sentiments. I would retain a cautious stance, but as of now things seem to be going pretty well for most of them.
So give us a few names that you like out of the consumption space.
The one name that we like is, among the larger names, is ITC, and I think that's the only one I would like to mention out here. We have just put out a largish report on that, saying apart from the fact that the company has pricing power in the cigarettes market, which gives it a kind of stability in terms of earnings growth, which is rare in the Indian market. Their FMCG portfolio, they are now other than cigarettes, they are, if you leave that aside, they are the third largest FMCG company in the country today, and losses have diminished significantly over the last few years, and maybe over the next couple of years it should start positively contributing to cash flows. So that's the one to look at in our view.
Anirudh, I'm going to ask you a trick question. What if a client walks up to you and his view is that, look, I'm ready to take a 15% downside, but I want multi-bagger ideas and my time frame is next 3 to 5 years. So identify 3 names for us which to your mind in next 3 to 5 years could be a multi-bagger irrespective of the market cap.
Right. I wouldn't like to identify names out here. I would stay out of that. But if it's a 3 to 5 year horizon, you can take a 15 to 20% downside. Then maybe some of the infrastructure, capital goods names, which have been, which are linked to policy action, etc., and have seen being completely decimated in valuations, could be good picks out here. And then depending on the risk profile, comfort with management, etc., and leveraging the kind of leverage that a particular company has, one will have to make those picks.
So what do you like within the infra space? Because infra again is a very broad spectrum. About 1,000 companies are limited. So let's restrict it down.
It's a very broad space, but if someone wants to play that sector, we have just upgraded BHEL, for example, some time back to an outperform, and that was purely a valuation and a stock price call. We know that there are difficult times ahead in terms of order inflows, etc. Similarly, we have had for quite some time had a reasonably positive view on JP Associates, because we think that their concerns on the debt is overdone. They have assets which have come into, which are on the ground, and there is a possibility of restructuring in the cement business, etc., which could overall drive up valuations and bring back investor interest. But in the current policy making environment, again, most of these calls, investors would be very cautious in taking a punt on any of these names. But there are some of these names which we saw how the stocks ran up in January, and could the same happen? Yes, on the back of policy action or risk on, the same could happen.
Now these are high risk ideas. What about low risk, low return ideas, where the margin of safety or margin of decline is less and upside could be capped, but those are safety stocks?
Look, in that sense, if you want to play the infra names, the two most liquid names and the best names are L&T and BHEL. So take your pick and stay with it. And if things were to turn really ugly, you could get out of some of these stocks. But at the end of the day, if infrastructure and investment comes back into India, as it has to at some point of time, these are the names which would give you very strong returns.